Good evening, everyone. You're all very welcome to tonight's weekly webinar, looking at the major teams, events, and really just to update all traders in relation to some of the volatility that we've seen into month end last week, Thursday and Friday, and really the onset of that into the early parts of this week. So, as you would have seen there a moment ago, government set to hold the 14th vote to reopen government amid the shutdown in the Senate. So it's really going to be all eyes to see whether we can obviously get this opened this week. So again, a lot of the US data prints is going to be kind of conditional, tentative, depending on obviously whether we get it fully opened or not. Now, some data prints will flow, some won't. So it's really just a case of watching that over the coming days, and of course monitoring the volatility that comes from it if things were to reopen, and for those other data events that does obviously or can obviously be released outside of the purview of basically the administration and government itself, and obviously local authorities. So obviously that's where we are in terms of the political spectrum in the US. Volatility has really started to ensue last week into month end. We saw that obviously that really aggressive move higher through the early parts of last week, with that gap higher Sunday into Monday, with the Chinese Trump data, and then of course we saw that continue higher Monday, Tuesday, and Wednesday. But we started to see the knuckle. We started to see that kind of pivot on Wednesday following the FOMC. We had a little bit of market volatility, and of course we started to see that really kind of pivot into the latter end of the week. We saw that initial breakdown on Thursday. We had a dead cat bounce recovery Thursday into Friday. Then of course Friday into the close we sold off again, before moving back into the range. And then of course Monday and Tuesday this week, markets has remained on the back foot. So overall, again, markets tentative to short-term volatility prints. I actually really just think this is merely of an unwind of kind of the volatility that we saw obviously in the 10th of October, consolidation, garner to gain new all-time highs, consolidation, and correctional plays. So in terms of the overall trend, not seeing anything too surprising. We're obviously getting gap closes in the S&P. We're getting gap closes in Wall Street from those moves last week. So it's that cyclical rotation play, right? We get a new high, we get a correctional pullback in risk-denominated assets, and of course we're seeing it across the board. We're seeing it in the S&Ps, we're seeing it in NASDAQ, we're seeing it in European equities with those correctional plays, and of course we're seeing it in the crypto space, which we'll look at later on tonight. So as we look at the calendar more broadly, a much more expansive calendar this week, because of course we've got a lot of data prints out even outside the US. So of course last night we had the RBA in Australia, the Reserve Bank of Australia, keeping interest rates at 3.6%. So they're in a pivot, or kind of more in a hold. Probability is that'll probably continue into year end, but obviously let's see what happens in December. And of course looking at the broader volatility amidst of all of that as well, because obviously we know the Kiwis have been cutting, they kind of held, they started cutting again, and then the RBA, it's kind of like wait and see approach, drop one, pause, drop another, pause, and kind of just play it out like by that. So they don't want to be too low, particularly as I said, if the inflation prints start to pick up. And of course if you were to look at the data prints out of Australia recently, you'd have actually seen that the core CPI is actually slightly higher on the scale as well. So that's obviously factoring into some of the short-term sentiment from RBA members as we look at the interest rates more broadly speaking. So that's kind of really where we are at in terms of that. And then of course as we progress through the better part of the week, and of course we've got speakers today. Obviously this morning we've had speakers. We've obviously got data prints tonight in Asia session with obviously Australian and Kiwi data. That's obviously going to be conscious of the fact that it's around market rollover, close to market over, and just following rollover. So expecting a little bit of volatility into the close. So normally on 10 o'clock GMT +2 with a lot of the servers, trading servers, you get that wider spread. If you're starting to get data prints amidst all of that, well, that's obviously going to factor into consideration as well. So worth keeping an eye, particularly if you're trading Aussie, Kiwi pairs, yen pairs. Just be mindful of the volatility, and even Aussie dollar, Kiwi dollar crosses, particularly let's say Euro Aussie, Euro Kiwi, pound Aussie, pound Kiwi. They will be conscious of the disparity in potential market volatility, particularly in lower times of market vol. Okay, so as we move into the better part of this week, obviously tomorrow being much more expansive again, let's wait and see what happens in some of these data prints. Normally speaking, at the beginning of the month you get the JOLTS numbers, you get the ADP, and then you get the basically the NFP for the new month. Now, of course, last month we didn't get any of those data prints, so we're really kind of tentative to that as well. I'm really kind of being closely gearing towards the latter part of the week to see whether we do get some of those data prints. Now, obviously, yesterday we got the ISMs. Tomorrow we should get ISMs, but again, let's obviously see on that. And as I said, there's not really anything else kind of worthy of note other than some of those kind of ISM prints tomorrow in the US. Now, as I said, we have a lot of central bank speakers in the wires. We've got German inflation data in tomorrow morning with factory orders. Interesting to see if the manufacturing side of things picks up, the composite services element, or if things became or continue to remain quite subdued. Now, again, industrial production will follow on Thursday in Germany with European data as well. So the next couple of days is quite busy in terms of your non-traditional big three, big four data prints. So when you talk about big three, big four, you've got employment data, CPI, interest rates, inflation data. So it's more retail sales, ISMs, PMIs. And then, of course, on Thursday, we've obviously got the Bank of England. Obviously, the expectation is to keep rates held at 4%, given, of course, the Fed is cutting rates quite drastically, and of course we've seen that movement in the dollar, which we'll talk about in a moment. Very interesting to see how does that fare into obviously the BOE, and of course obviously we've seen Rachel Reeves, the budget, and that's dominating a lot of the political spectrum here in the UK as well. But all intents and purposes, the rate on Thursday is expected to remain unchanged by the Bank of England. Obviously from the prior unchanging from 7 to 2, expected to go 6 and 3, so 6 remaining unchanged, 3 to vote for a cut. Anything outside of that, if we were to, let's say, have 5 voting for a cut, and we actually do get a cut, well, that's obviously going to be a surprise move, which will give a short-term interesting narrative to look out for in pounds. So, of course, if we do cut rates in the Bank of England, you'd actually be expecting for that continuation in that weaker pound, and you'd actually expect a little bit of upside progression in the FTSE. But, of course, that's only on the conditions that a rate cut would occur. So, at this moment in time, that's not the expectation, but obviously it's important to prepare for all eventualities. And then, of course, as we progress through Thursday, as I said, we're out of the Fed meeting last week, so we're going to get all the individual opinions this week, next week, the week after, by all of the different voting members and broader members as a whole, those non-voting members as well. So that's obviously going to be very, very interesting, of course, given the Fed cut rates last week as well. And then, of course, as we move into the end of the week, we're meant to have NFP on Friday. Whether we get it or not is obviously wait and see. We didn't get it last week, or last month, should I say. We didn't get the ADP numbers last week either, or last month either, should I say. So it's really kind of contingent on what happens with the shutdown. If this shutdown continues, well, obviously we're not going to get NFP numbers for another month, which obviously means there's 2 consecutive months where we're not getting reported data, which really kicks the curve into Christmas. Really seeing if there's a negative annotation associated with that, because a lot of people were kind of expecting end of October, let's get things reopened, let's get everything floating again. But if we move into the middle part of November, it really pushes the mandate for a weaker Fed in December to cut rates again, much more probable, and you'd see the likelihood of another Fed rate, 3rd consecutive rate cut, like what we've talked about in July and August, being much more of a likely scenario. So really interesting narrative there to look out for on Friday. And again, that's going to be contingent on short-term volatility and obviously the geopolitical elements internally with the US between obviously the Democrats and the Republicans in the Senate. So keep an eye on that one. So overall, a busy floating week with different data points in different geolocations. Obviously last week was central bank week. We've obviously got the Bank of England this week as well. So that's going to create short-term volatility in UK division assets. So obviously pound, FTSE, obviously worth keeping a close eye on as we move, as I said, into the first full trading week of November. Now, as we look at the first full trading week of November, as we kind of talked about, that kind of residual trend, that kind of higher high, higher low scenario, middle of October, we saw that 3-4% correction, market stabilized, we went on to create new highs, we had a gap higher. So we're getting those cyclical rotations, trend, correction, trend, continuation, pump to new highs, trend, correction. So we're not, although we are quite negative the last couple of days, and of course in the crypto space again, all fire hasn't really broken loose as of yet, because the declines even in the stock market, you're still within that kind of 3 to 5%, and even from the current all-time highs in the likes of the S&Ps, you're still only at 2.5%. If you look at the NASDAQ, which hasn't even filled the gap close from last Friday, the 24th, into last Monday, we're just about getting down into there. So it shows that even despite the volatility last Thursday, last Friday, the negative nuances and the narratives that's been portrayed in the markets, it's still only back to really where we're started and hasn't even retested those all-time highs. So you're probably expecting a little bit more shorter-term negativity into probably the better part of this week, in line with short-term sentiment, and then looking for that cyclical rotation, right? So whether it's a retest of all-time highs, whether it's a gap fill, these are things that as traders we're going to have to be very, very conscious of as we move into the potential scenario of NFP on Friday. So that for me is going to be quite interesting as well. And that's not just across the board in the S&Ps and the NAS, it's the same unilaterally for the Dow. So the Dow is a little bit more bearish leaning. It got the gap close on Monday, and has continued to kind of cyclically rotate to the downside, but really only moving back into fair value. So that 46.5, 46.6 still in play, despite us currently sitting at around 47 of 48.2 all-time high. So again, cyclical rotation, trend ends, pullback ends, consolidation occurs, we get that next leg higher in stages. And of course, as we talk about religiously, what goes up will come back down eventually. It's just those narratives, it's the crossover in sentiment, it's profit taking on the liquidity side of the book, and then of course understanding and watching for those shorter term counter retracements. Now we talked about it last Wednesday, the Fed being a potential narrative for that. We did get a little shakedown, we got a secondary shakedown on Thursday, and then it's really this week where markets are starting to develop and kind of create a little more downside progression. So really that's where we are in a broader kind of mandate in terms of price structure. It's really just kind of looking at where we've been over the last number of weeks, which has been incredibly bullish, the gap fill last week, that progression through the middle of last week, and that cyclical rotation back down. And that's really kind of something worthy of note. Now, how progressive this retracement is really going to be dependent on how aggressive the negative nuances associated with these markets are. And of course, in the back end, the VIX curve, right? We talked about the VIX curve last week. We pretty much nailed the VIX curve. We said last week the probability is into FOMC and into most of last week we were going to remain between 15.5 and 17.5, and that's exactly what happened. So the FOMC, we had a little bit of a brace higher, didn't materialize. We got it moved back down. Thursday, very up and down, and then on Friday, as we start to see a little bit more selling pressure come through again, we started to see that VIX move up through the gears. And of course, when we mean that, moving back above that 17.5 price point from where the VIX had spent most of the September, early October, before we had that massive spike on the VIX. So obviously the 10th of October, the VIX spiked, we got that secondary move, markets rotated back down. And often the time for looking at cyclical rotation, counter trend movements in equity markets, in the likes of the S&P, in the likes of the NAS, is when we get those up, back down. And then of course what happened from there over the last couple of days or so, VIX has picked up again. We gapped higher yesterday into today, into 20,000 or 20.5 on the index, and we're getting kind of a counter reaction, a short-term retrace into the gap fill. And as I said last week, 17.5 is going to be the pivot point, and I would even say the same thing again, given of course we've gapped higher. Do we expel lower, try and fill the gap, and ultimately try and push on more volatility into this week to create a deeper runoff in the likes of the NAS, a deeper runoff in the S&Ps, Dow, etc., to create more of a retrace. Now, as I said, VIX is going to be key. Higher time frames also important. VIX gapping higher. It is on the back foot today, which is creating that kind of pause or kind of short-term consolidation at little under 6,800s. NASDAQ around the 25.6s, and the Dow around 47.1, 47.2. So if that VIX can come down, fill, and start to pipe up another move, a leg higher into those low 20s, so you're talking kind of 22, 23, then you'd absolutely expect the S&Ps to continue running off. And of course, 6,700s, a bit of a fair value area here when you look at even volume profiles, but obviously from a liquidity standpoint, a lot of action down here between kind of 6,650, 6,700. Wouldn't even be remotely surprised for the S&P to do that. And of course, when you look at that secondary runoff from the middle of last week, not last week, but the week prior, from the 22nd to 23rd, it was in around the 6,700s where markets kind of got that oomph, got that breakout, got that progression, got the new all-time highs. So we went from 6,700 to 69s. Wouldn't even be surprised that if the VIX continued on the upper side this week, that we actually saw movement back down at that 6650, 6700. So that is a downside target to look out for if the VIX continues to remain on the up foot. And of course, that would be contingent on VIX actually pushing higher on either a hold of the 18.5 or a hold of the gap fill, where price action ultimately comes down and then looks to incrementally try and push on again. Of course, that's going back up into those 21s, 22s, 23s, where we were in the middle of October. Okay, so really using the VIX curve for short-term volatility session to session will give us a very good idea whether this sell-off is ultimately going to continue to downside. So as I said there a moment ago, S&P's to 67, NASDAQ back to all-time highs. You're talking a 25.2 handle. The Dow probably 46.5. So that's kind of 500-600 points lower on the Dow, 300 to 500 points lower on the Nas, and the S&P's for potentially another 100-point runoff potentially, as I said, if that VIX can create more upside progression. But it's really just contingent on watching price discovery, I think, on the VIX curve around that 17.5 as we move into this week as well. All right, so that kind of gives us a bit of a context on short-term volatility, where we are within the market cycle, both short-term and the medium-term over the last number of weeks. Looking at obviously some of these narratives where we're talking about obviously the shutdown, we're talking about obviously some of the data prints, the debate of whether we're going to get NFP on Friday, and then of course obviously some of these alternative narratives like Bank of England geopolitical elements in terms of globally, with obviously what's happening in the Middle East and Asia as well. So that's kind of where we're pivoted at this moment in time. Also, the interesting narrative is the dollar picked up. So I have been very vocal in terms of the last kind of 6 to 8 weeks, really from the September Fed, but more kind of elongated last week, looking for that dollar pickup. We saw the exact same thing in 2017, 2018. We've talked about for many weeks now. We saw the exact same thing last year. Fed cut, stronger dollar, and that play is actually kicking out. So everything you would have thought of, well, actually when the Fed's cutting rates, we get weaker dollar, is actually not applying. And it really looks to me now that we're going to get a little bit of a bounce in the dollar, and it's really how progressive this bounce is. We're currently above the 30 July highs at around 100, but that really kicked on last week when we talked about it on Wednesday, where the price structure got above that 99 handle. And I think when we got above 99 and sustained through really into Thursday, it was this dollar trend is going to go higher, and that's exactly what we've been advocating really for the last week. Euro dollar sold off from 116.50. It's now trading in the 115s. It's actually gone below 115 in the last couple of hours, as we trade 114.80, and really would not be surprised if we were to see 114 ultimately taken down, but actually a deeper runoff. So it's the next kind of phase in obviously euro dollar weakness, cable weakness, is contingent about how progressive this dollar rally is. And I think short-term perspective, I've been looking at kind of 102s, 103s. I think you've obviously got a short-term headwind there around 101. But I think beyond that, it's really looking at kind of 102s, 103s. Because when you look at the broader structural dynamics, we spent a lot of price discovery most of 2023, most of 2024, between kind of 100.5, 101 lows up as far as the kind of 107 highs. And that, for me, that midpoint was really, a lot of the volume was around that 103 mark, 103.50. So really for me, it's all eyes to see whether price structure gets above this. And we, as you can see tonight, we are trying to break back above it, but ultimately a break above 101 symbols that continuation, symbols that short-term recovery in the dollar. And it's basically last year when the Fed increased rates, we went from 100 to 107, 108, got to 110. This year, Fed is cut twice, September and October. It's no surprise we're repeating the same thing. Okay, so it's just being wary of that. We've been advocates. We've been talking about a stronger dollar in the markets for the last probably 6 to 8 weeks. I've mentioned it many times myself over recent calls, and we're really seeing that play out. So for me, it's a case of how progressive is the downside in the euro dollar. Well, if we do see 103s in the DXY, I would not be surprised if we saw euro dollar back at 112. And that's another 250 points. Now, whether we get to 112 or not, let's wait and see. You've ultimately got a weekly fill of the wick at under 114. I think price is going to come for that. And I think it's really progressive of how deeper we run off through that. So it's really somewhere between kind of 112, 113 would be a very, very conscious, conservative estimate for price structure. As I said, if this dollar kind of kicks on into that 103 handle. But let's wait and see on that one. Cable has completely, the arse has completely fell out of it. But what's actually interesting is there was multiple moves lower within the terminal structure, multiple dead cat bounce recoveries. We had it in September, dead cat bounce recovery. We then had it then ultimately, sorry, on the daily structure, let me just, it's very clean on the daily structure. Again, secondary bounce in October, dead cat bounce recovery. We called secondary shorts at 134.50, and since then we haven't really looked back. So dollar trend is continuing to take up to the uptick. So you're probably looking at, as I say, 112.50, 113 euro dollar. We could very easily see 127 on cable. Okay, and that's what I would look out for over the coming weeks to see how progressive this DXY weekly, monthly, short-term revision to the upside is over the next, let's say, kind of 8 to 12 weeks. But really looking to see, can we actually get above 101? If we get above 101, you're seeing cable move back into those mid-20s, right? So you're talking probably 126, 127 as a base case scenario. As I said, euro dollar, we could very easily see 112. All right, so that those types of numbers make sense if narrative is continuing. Now, again, I'm expecting the Fed to cut again in December, which leads to 3 consecutive cuts. We'd only 1 cut last year. We saw a significant move higher in the dollar. So really that narrative, that idea of seeing a 103 DXY in the next, as I said, 8 to 12 weeks is not unrealistic by any stretch of the imagination. So it's just important to be conscious of that, as I said, as we move into December. Seeing again how the liquidity side of things holds up. Do we get any more? Because we obviously know QT is ending on the 1st of December. Powell confirmed that last week in the Fed. How long is the difference between the runoff and the end of QT before we start to see the re-emergence of QE? Is it immediate? Is it 3 months? And I suppose that is something that we'll be looking very closely on into Christmas to see if there's any sort of clues by central bankers, if there's any sort of comments by Fed members for any sort of kind of idea of when that will take. Because of course, when we get QE revisited and reintroduced after QT ends, that's where we get global liquidity ticking higher at a more significant rate. And that's really a case of then how does the Fed, how does the Treasury as a collective navigate around rolling the debt. So there's about 7-8 trillion of debt to be rolled in the next kind of 6 months, and how and at what rate are they going to try and do that. So that's really going to be very, very interesting, considering the Trump mandate through 2025 has been, we want a weaker dollar, we want to get the rates low as possible, but is this the cycle low for the dollar where per price action ultimately goes back up into 103, 104? Quite possible. Okay, so let's just see how that one flows. But as I said, trend structure has been so clean, and I think really now, if you're looking at short and cable or euro dollar, you really have to be looking at it on pullbacks. So the ideal scenario would be that price structure on the DXY would probably come into that 100.75, come into 101. We get a short-term move lower. So like a potential scenario like that, creating maybe a short-term pullback, similar to what we had last week, or even, sorry, last month, with that move from 99.6 back into 98, getting that move, getting that corrective play, and then that's your load up for the next wave lower in euro dollar shorts, right? So that's probably the cleanest mandate, because do you want to be trying to chase euro dollar shorts at kind of trend lows? Do you want to be trading cable shorts at 130? No. You want to be looking for those dead cat bounce recoveries, those short-term recoveries, like what we had here in September, like what we had here in October. And this is the catalytic move that you want to be looking out for. You don't want to be selling at new lows or kind of near new lows without any sort of clear retracement, because I just think you're just chasing dead money. Okay, so that's the mandate there for the FX side of things. As we look at obviously the gold scenario, gold has been quite interesting because of course how choppy it's been. So naturally we had that aggressive trend higher, tops comes through, we get that aggressive breakdown into the end of October, we get the dead cat bounce recovery, come off 41.50 we talked about last week, down into 39s. Since then it's trading in within range, right? So you're looking at short-term lows at 3900 holding up, short-term highs under 4050 being kind of the local tops into month-end October, Halloween. And really since the end of November, since the beginning of November, should I say, with that tick higher in the DXY, gold prices remains slightly more on the back foot, but still holding above 3900. So that's going to be an interesting narrative, that if the DXY continues to remain quite bullish, we got kind of continuation, let's say, into 101. Does that allow for gold prices to run off? So Again, apex up, short-term trend structure, breakthrough, taking out 39s, and then you're looking at the next key level. So for me, that's probably around 37s. So breaking through 38.50, 39 brings in 3,700. And that'll be a very interesting narrative to look out for into potential NFP on Friday, because we know gold tends to be a strong reactive of NFP when the data comes out. So that'll be something to look out for as well if you trade gold, to see if there is that catalytic breakdown to replicate kind of what we're seeing in the euro dollar, what we're seeing in cable prices. I know obviously gold has been very strong, but gold was up 61% year to date. So it's not really surprising to see a move of a corrective stance like what we've seen. So gold is currently from all-time highs to even the 3,900. It's only off 11%. Could I see gold coming back 18-20% from the all-time highs? Absolutely. If that brings us into 18-20% level, you're in that kind of 3.6-3.7 ballpark, where you start to see 15, 16, up to potentially 20% declines. But as I said, that's also going to be contingent on the short-term play of the dollar. Does that dollar ultimately kick on to 103? And as I said, if we were to see dollar 103, I would not be surprised to see gold down 16-20%, trading back at 35.50, 3,600. And that would really be your apex up, your top formation, phase 1, phase 2, phase 3, deeper runoff, consolidate, look to accumulate then between the 36, 30, 35, 36, 3,700, and then that could be the apex being undone for markets to ultimately move lower. Now, the previous breakout zone is actually at 34, 34.50. To go from 3,900 to 34.50 as a corrective play is actually quite expansive. Then you're into bear market territory in gold from the all-time high, because it's down over 20%. So then you're looking at that corrective space. So, but again, still massively up on the calendar year, because we were at 2.6. We started the year. We went from 2.6 to 4.4. Would it be surprising to see gold at 3,400, 3,500 and create a 20% correction? Absolutely not. So let's just see how that flows. I think the gold correction is dependent on how strong over the next 8 to 12 weeks the dollar is. If that dollar strength continues, we've been nailing it on the button so far for the last kind of 2 to 3 months. There's no reason why it can't continue. So obviously that would allow for gold prices to continue that runoff. But short-term perspective, you're really looking to see, does that 3,900 give way for that constructive viewpoint to see these markets continue to pivot to the downside. Now, moving out of gold, moving into the oil play. We talked about the oil moves last week off of that 61.50 handle down at the 60 lows. Since then, it's been very back and forth. So surprisingly enough, I actually thought oil prices would actually pivot lower once it tried to break through 60. As we moved into last Thursday, it kind of continued to remain above 60 and has continued to migrate back and forth. So that's quite an interesting take there. Obviously, we had the inverted move we talked about last week into short-term consolidation, dead cat bounce recovery, strong reaction off of 61.50, which incrementally was this value area from Friday the 24th, where we had that apex, and then ultimately when the markets broke down, came back up and allowed for the rejection, and that has allowed market participants to create that retest of that value area, which held up very, very beautifully yesterday. And since then, we've actually gone back into this 60 handle again, and that 60 handle low there. So I'm still hopeful to see oil prices move lower. If that narrative does continue to develop, it's really looking to see this break. If this breaks, I think you get your undoing of this unwind. So you've obviously this corrective play back down, aggressive impulse into 61.50, 62. Break is 60, sees obviously this progress lower. And as we talked about it last week on the cable print, when we had that aggressive move on cable, we talked about, just to refresh, we had that apex break down, it hung about, and then it obviously dove off. So you're really looking at this type of move here, where we've got period of consolidation, breaks up, dives through, takes out structural lows. And if that is going to play out here, you're really looking at these structural lows here being taken out around the 60 print to allow that runoff. And that's similar type of scenario in UK oil, Brent. I tend to prefer trading WTI over Brent, but again, very interesting narrative, up, back down, and then you're really looking at 63.50 giving way for that runoff back down to 60. And incrementally on both types of structures, you're looking for, probability is we actually move lower to retest those lows. So that's obviously on contingent that we see that oil price breakdown. So keep an eye on that one. I'm going to set wheel alert down here around 59.60, but I'm also going to set an alert where price action breaks through the 60. So at least that way then I can kind of watch it in real time as it's developing. But I definitely would still see this moving lower until such a point where we don't actually break through 60. If we were to come down here into this platform area and not break through and rebound again, for me the invalidator is really taking the short-term highs and breaking above this value area here, which is between 61.50 and 62. All right, so keep an eye on that one. We've obviously gone through the FX side of things. ES on the futures, this is the S&P futures. It's kind of replicating what we're seeing in CFDs. So obviously apex up, progressive move back down, gap fill, and really moving back into this value area. So like what we talked about with the CFDs into 6,700, really probable that we could see something similar on the S&Ps. You only have to look at this area here, which is the dead cat bounce recovery after the previous cycle low, followed by the breakout, followed by the move lower, and this V-shaped bottom here before we ultimately broke up. So would it be surprising to see ES into this 6,700 as well? Most probable as well. So do keep an eye on that, as I said, over the coming days, depending on whether you're trading CFDs or futures. And then, of course, as we look into Europe, the German DAX we talked about last week, the short-term range was 24.4s, 23.750 absolute bottoms, 24,000 being a bit of a midpoint lower, 24.1 being a midpoint low with some of the structural bottoms. But of course, with the price action today developing, we've literally gone back down into this platform area here, and of course dead cat bounce recovery off of 23.750 again. So the analysis that we talked about last week, V-shaped bottom, dead cat bounce recovery off of 23.750 has played out again. But interesting to see whether that holds, because as I said, we could very easily see that give way and the price structure to actually take this out and ultimately try and make new lows. So you're talking 23.3s, 23,000 as another impulsive low, because of course how progressive this trend has been in DAX over the last probably 6 months. Apex up, back down, apex up, back down, apex up, marginal new highs each time. So marginal new high and a bare new high before markets ultimately rolled over. And if that's the case, then does the German DAX really end its year gains on the upside and become more of a consolidation structure between 23 and kind of 24.5, 24.6? And that would become the fear for European asset managers, because of course you then have to look at that cyclical rotation into S&Ps, buying the dip in the NASDAQ when these corrective plays end ultimately as well. All right, so that's the German DAX. FTSE is obviously quite interesting because of course we had that run off yesterday into today, followed by that massive impulse back up. FTSE has been very, very strong on the upside. So obviously we had that corrective move. A lot of V's at the minute in the FTSE, which is quite interesting. We had it on the 10th. We had that V up. Then we had it on the 17th of October. And then, of course, today into yesterday, we've had another V-shaped bottom. But from my perspective, just be cautious of upside progression in the FTSE, purely if this area here gives way. So this was obviously short-term tops around 97.50. And then, of course, since then, we've literally moved laterally towards the back end of last week. So Thursday, Friday, Monday, stuck in this kind of 3-day range or 4-day range. And then, of course, aggressive move lower, aggressive move back to value area. And it's ironic that when the markets move back up, it's held above this short-term value area, but hasn't taken out any of this. Hasn't taken out any of this price structure here. So we're still holding under 97.50. So for me, watch out tomorrow, because the last thing you want to do is be long and then ultimately we break value area, this 3-4 day trading range, we break the bottom of this consolidation range around 9700, and ultimately we dive off. And if we were to dive off, we probably retest these lows at 95.75 with the likelihood of probably making a new low. So just be careful of any price structure breaking beyond the range below kind of 9700. Okay, so just keep an eye on that one, and if that does play out, you're kind of into similar rotation like what we saw with the S&Ps, get to new all-time highs, break down, unwind, and then we move back to 94. So again, Thursday's Bank of England interest rate meeting becomes very interesting for the FTSE to see whether there is a corrective play or whether we actually hold V-shaped bottom, hold a structural low, and ultimately Bank of England potentially surprises by cutting rates, and then we see FTSE at 9800. Could very easily be a scenario too. So we just have to look at some of the fundamentals short term. Okay. Last but not least, for tonight, Crypto space getting absolutely hammered. So we had it obviously on the 10th. We had it obviously last Friday week on the 17th. We had it again yesterday. That 115 top that we talked about last week played out nicely. Really thought this was a kind of an interesting area in BTC to see whether it would actually hold above it. So we had a lot of volume here around that 109.50, 110.50 short-term low. We had a dead cat bounce recovery, but then we had another wave on Thursday. Smashed right through it, breaking through to 106.7, and then incrementally that became the ceiling. Dead cat bounce, back into yellow area. A little bit of pause Friday, Saturday, Sunday. And then, of course, price action broke down again. Broke down through 109.8, down into those, retested those lows very quickly, and hasn't looked back. So we've gone from 110 to 1,000. And the interesting narrative at the minute with BTC is the amount of leveraged longs. Those with leveraged longs and those panic selling has created this short-term divide. Now, I'm still bullish. I still think BTC gets another euphoric move higher, but I had to shake out the weak hands. I had to shake out all the leverage longs, and I had to create a dip opportunity where people can buy on. And as I said, when you're looking at the crypto cycles and this crypto rotations, it's not uncommon to see 20, 30, 40% corrections in BTC, Ethereum, any of these main altcoins or any of the minor altcoins in a bull market, right? When you see price action going from 74,000 to 123,000, it's not remotely surprising that we see a 20-30 grand retracement on that. And of course, when you look from all-time highs to where we're currently at, we're around 20% dip from the all-time high. But when you see where we were in April of this year, we're still up 30-35%. Okay, so you kind of have to take a step back and look at kind of where we are. It's a high vol asset. It's a vol above 70. So naturally, your upsides are going to be very bullish, but your downsides are also going to be quite bearish. So you have to have that risk tolerance. If you're trading this asset, understand how volatile it is, and the same applies for Ethereum. Right, we've went from 1600 up into almost 3000, 2800, and then we went from 2800 up into 48. Right, so that's again looking at that progressive move. That was a 225% gain. 225%. That's not small vol, massive vol. And then of course on the downside, you're getting the same counter reaction in terms of retracements. Now Ethereum is 35% off the high. Where does this bottom? Well, we've broken through 3.5, which for me was a really ideal buying area, because of course that was the extremities on the break and retest, but could very easily see 3.228 if vol continues. And again, it's really just how aggressive this is. Could we see 2.8? Possibly. Who knows? Let's wait and see. But just be mindful of the volatility, and as I said, with the short-term corrections in the likes of the S&Ps, the pickup in the VIX curve, if the VIX curve would to go to 22.50, 23, 22.5, 23, you could absolutely see Ethereum at kind of 2.8, 2.9, because it's at 31.85 at the minute. All right. So as I said, a lot of moving parts at the minute. It's important to take a step back. So whether you're net bullish or net bearish, doesn't really matter. It's about looking at the rotations. It's about looking at the VIX curve. It's been looking at the volatility short term against those broader macro trends. Putting perspective on things, I think, is ultimately very, very important. Looking at the seasonality factors. Of course, we've had earnings for the last 3 or 4 weeks, which I think has probably helped springboard that recent high. And then, of course, we're getting a little bit of a dump off after the fact. So that's the typical buy the rumor or buy the short-term narrative, and then when the profit taking's in, you get those corrective moves back down until the next positive narrative comes out. All right. So, guys, I'll be back tomorrow. Really to kind of keep an eye on price structure, see if we get those continued declines, get those continued pullbacks, how does price structure develop in the VIX, and of course dollar in the back end really becoming very, very interesting, as I said, over the next kind of 6, 8, 12 weeks or so as well. All right, so as I'll leave it there. We'll be back tomorrow for US Open, hopefully back on Thursday in some capacity as well, all going well. And as I said, in between all of that, really looking to see what the next I suppose narrative is with this government shutdown, because I think that's probably starting to factor in as well. I think people were expecting the government shutdown to end towards the end of October. We're now first week into November. We're not really any further progressive in terms of the end. So that's probably waning on markets as well. So probably the shutdown is helping to create this correctional play on the downside as well. All right. So we'll see you all tomorrow, folks. Have a lovely evening. Trade safe and see you then. Thank you.